happy weekend there, Maverick Traders. This is Rob Reinhold. This is the Trading Room. We are going into January monthly options exercision. Let's get into it. All right, so this week we had a pullback. We had more market weakness. This marks about 2 to 3 weeks that the market has been soft. And on Monday, we actually got a gap up on Monday. And look at that selling that happened in the NASDAQ stocks. The news came out that NVIDIA was a keynote speaker at the Vegas CES show, and everyone was excited, and then all you got was sell on the news. So classic, buy the rumor, sell the news, but the selling lasted all week long. And on Friday, one of the biggest things that happened, in my opinion, was that the U.S. 10-year government bond broke out of the 2024 high, and we're now trading at the highest we've been in a while, and we're approaching that 5%. The U.S. dollar is trading near 2022 highs. Both times that happened in the past, the equity markets really struggled. Now, we did have a very historic event. The stock market was closed on Thursday, which usually doesn't happen, but they did that for Jimmy Carter's memorial. Let's get into the economic reports that came out, and I want you to just see how strong these numbers came out. So here we got the ISM services and the JOLTS job openings. Both of these numbers were much better than expected. So we have more job openings available. We have a much stronger services PMI that is 2/3 of the economy. Just crushed the estimates. And then we got unemployment claims at 200K. This is an extremely low number. So this is the number of people filing for unemployment. That's a very low number. I've only seen it sub 200,000 a couple times in my life. This is right there. And then take a look at this payrolls report. This payrolls report was just a stellar report. 256,000 jobs, 4.1 unemployment rate. All of this data came out saying that the U.S. economy is strengthening. It's not cooling off. It is strengthening. So then why would the market fall on this? Well, it's because of the Fed. The market has been thinking we're going to get a few rate cuts this year, and it doesn't look like that is as likely as it was before. And frankly, we're making a call that there are no rate cuts this year and potentially even a hike. The market is not priced in for another rate hiking cycle. Now, we do have CPI this week. That's going to be a major report. If that's hot, I think the market is really going to struggle with going any higher at this point. So let's go in and take a look at the actual numbers, what happened today. As I said, it was a down week, but it wasn't a murderous week. It was down 1.5–2% on the Dow and S&P Qs. See, Russell got hit 3.5%, but take a look at oil and gold. They did very well. The energy sector is the best looking sector at the moment, and the gold market is having a nice little bounce off of its recent weakness. Let's take a look at the S&P 500. And I really want to just detail technically where we are. We have had this big band of support somewhere in this 58.30 to 58.60. And you can see, of course, on Friday, we literally close at the bottom of that support, 58.30. We haven't broken it yet. We pierced it. You can see that little long lower shadow, but we pierced it, but we didn't close below it. This means that we are actively breaking through support, but until we get a lower low and then a lower high, we cannot call this a bear market. But we definitely can say that it's looking more and more likely that we are going to get a bearish move here. All right, now I want to just dial that back a little bit. If you've been listening to me for any period of time in the past, you will have heard my talk about how I was a perma bear. From 2001 to about 2005, I was a perma bear. I wanted to be short all the time. I didn't like to be long. Everything was going to be falling off the table, and I was always negative. And all the people I liked on CNBC were the people that talked negatively. All the people that talked positively on CNBC, I called them a bunch of cheerleaders, and I totally didn't listen to them at all. This is how we are as human beings. And the technicals are absolutely saying, get ready for more bearish price action. But let me reel you back in, because over 28 years as a perma bear, a performed perma bear, I have learned one thing. If the economy is doing okay, then the stock market goes higher. Now, yes, that doesn't mean it goes higher all the time. In that long-term bull market, there's going to be pullbacks. There's going to be corrections of 10%. There might even be corrections of 15 to 20%. So I'm not saying that we can't have a substantial move lower here. What I am saying is it's likely to be short-term in nature because the economic background is strong, the economy's growing. All those numbers we got right now, yes, it brings up inflation problems, it brings up higher interest rates. I understand why the market's going down, but none of this kills a bull market. These are the catalysts of corrections and pullbacks. If we take a look at the Qs, the Q is looking the same, really the same pattern here. We've broken down. We are likely to get lower prices, and we're likely to probably go down to the next level of support, which is going to be about 3% away. So 3%, I think, is what we're looking at on the downside here. But if the economic numbers stay strong, then you have to look at this as what it is. This is likely a correction within the bull market. These corrections can last a couple weeks. They can last a couple months. But we don't think we're headed for a major recession with a bear market that lasts for 10 months. It's just not where we are at the moment. So yes, we're bearish. It's very clear we're bearish. You should be bearish short term, but I don't think this is any reason for any of you to panic. I've had people reach out to me and say, Rob, what do I do about my long-term holdings? Should I sell them here? I'm like, look, the economy's still doing good. I think selling them here is an overreaction to the short term. If the data changes, then yeah, sure, lighten up on those. But until the data changes on the economy, this is likely to be just a pullback or a correction. If we take a look at the heat map here, you can see there's some areas that were pretty good here. Healthcare was nice, and we've got an upgrade here on healthcare. Energy was very nice. Utilities were nice. There were some nice little moves here within this market, and it's not solid red. It wasn't a total disaster. We just got a little bit of selling here. So what does that mean for next week? These markets are barely holding on to the support. I don't think we can say we've broken support yet, but it looks like that's likely going to happen. When that happens, we can get that cascade effect. We get that margin selling. We get that panic. We can absolutely tumble another couple percent. There's no question that that's probably the most likely scenario here. However, the economy's still good. The economy's still strong. And at some point, people are going to come back in and buy this market if they believe the economy is still on track. So I think it makes sense to be short-term bearish. A week, 2 weeks. I'm not really going out any more than 2 weeks on my bearishness. And then in 2 weeks, if it's still bearish, I'll add on to that bearishness. But I'm going to keep everything very short-term here on the bearish side. The higher bond yields are a big problem. And as we get higher and higher, all of a sudden, bonds look more attractive, fixed income looks more attractive, and less money goes into the stock market. That's the biggest problem with higher interest rates, is that it's going to divert money that would have gone into stocks into fixed income, which the bull market in stocks needs more money to move it higher. So yes, the market is flashing some red signals here short term, and I think we need to listen to them, but I don't think this is the end of this economic run. It's not showing up in the data at the moment. Next week, we have some pretty major data, and I think this is going to be the day. I could see us staying weak until we get to the CPI. We get the PPI on Tuesday, maybe that gives a little relief, but this is a major number. This is a major number. We've got hotter data coming out. If this number comes out hotter than expectations, which is +3 on the headline, +2 on the core, if it comes out like +4, +0.3, this market has to reprice itself. Remember, right now the market is priced for 2 rate cuts in this year. If this thing comes out higher, the market has to reprice to possibly no rate cuts this year, or maybe even a rate hike. Everything needs to be repriced, and that's likely going to be the catalyst for this little sell-off I think is brewing. If this number comes out okay, then I see the market being soothed. Market saying, okay, the economy's strong, but inflation's not out of control yet. I think the market is going to be soothed. Does that mean I think it's going back to new all-time highs? I do not. I think it's going to take some time to repair some of this damage. But this number on Wednesday is absolutely a critical number. And if these numbers come out more than expected, I think you really got to look at a 3% sell-off, if not even a little bit more. We do get retail sales on Thursday. I don't think that really matters all that much. The CPI data is going to be the important one. So where does that put us technically? Well, technically it puts us at a -2. We are below the 20, below the 50, but those two lines have not crossed yet. They are not both pointing downward. So we are definitely more bearish than bullish at this point. But I want to caution everyone, let's not get overly bearish here. We are hanging on support. We're right there. And really, like I said, we can pierce. There's lots of times the market pierces support and then bounces right back, and it was not a movement. We really need to see the pierce, the rally, the failure. That is going to be the real confirmation that, okay, now we can get a little bit more bearish. Now we can actually look out maybe 3 weeks, 4 weeks for some bearish trades. But right here, right now, I think you want to keep everything really close to -1 and really short term, because if we do get a bounce on that Wednesday CPI, you want to be able to avoid really painful reversals and then be able to get into some bullish trades to even out. But I am definitely going to be leaning on the bear side here over the next week or so. Let's go ahead and look at those sectors and score those all from +3 to -3. That's going to tell us where to allocate trades. If we take a look at the performance last week, we had 3 sectors that were positive. Healthcare was positive, energy was positive, and materials was slightly positive. These have been, well, let me just take energy out of the picture. Materials and healthcare have absolutely been the worst sectors over the last 60 days. They've been atrocious. Healthcare has stopped going lower. Materials, let me say that again. Healthcare has stopped going lower and actually has started to put in some higher highs and higher lows. So healthcare technically is looking a lot better. Materials got absolutely obliterated and it's basing. It has not bounced back. So we're going to treat healthcare a little bit differently than materials when we get into the chart. And you'll see that healthcare is looking like it's a decent bullish sector to be in, where materials just does not. On the losing side, real estate got absolutely crushed. And then everything else was down 2.5%, 3%. And we got all of the best sectors that were showing all the strength: technology, consumer, financial, comm services. They've all now given up that strength and are underperforming the market. So let's go through and score all these sectors from +3 to -3. Utilities was a -2 last week. It's a -2 here. It's below the 50, it's at the 20, and both the lines are sloping downward. So again, we're moderately bearish on utilities. Coming over here to communication services was one of the best sectors, and then it broke down. We downgraded it. It traded in between the moving averages, and you can see it is now broken down below the moving averages to a -2. If we had like decimals here, this would be like, for me, a -1.5. We're basically 1 day off of the moving average. Yesterday, if we scored this, it would have been a different score. Today, it's in a -2. I'm not going to get too aggressively short on comm services. Next up is real estate. This is an atrocious chart, an absolutely atrocious chart. Look at this tight low base. I mean, this thing didn't bounce to save its life, and then it just broke down out of it. I think you can stay short real estate. Moving next into healthcare. Look at those moving averages. Healthcare has been very weak and heading lower, making lower lows, and you can see we now have made some higher lows and some higher highs. We can actually upgrade the healthcare sector from a -3 to a -1. Now look, that's still bearish, but it is by far less bearish than a lot of the others. And speaking of the most bearish, take a look at this industrials. This is just atrocious. At least real estate based sideways. This thing actually lost some ground while basing sideways. This looks really weak. We got a -3 here on the industrials. Financials is one of those sectors that were holding up okay, and then you can see we bounced back up into these moving averages, and then we turned down hard. We've now broken down below this last support. So it's not a -3 yet. The moving averages haven't both turned down, but it's a -2. Looks bearish. Over here to consumer discretionary. That was the best sector at the end of last year. It pulled back, it failed. And you can see we've now failed again, but we're still holding here. I am definitely, more bearish than bullish here on consumer discretionary, but it's the least bearish out there. It's a -1. Yes, it's likely to break down below that 50-day moving average and go a little bit lower, but this one's holding up better than the rest. Take a look here at consumer staples. This is just an absolute terrible chart here. It just keeps breaking down. There was selling all week long. This was a -3, and it's going to stay a -3. There's no relief on this sector at this point. Moving into tech. Tech was a 0 last week. It's now down to a -2, but I just want to point out that tech has really just been sideways for the last 2 months. So that's just where we've been. Yes, we're at the bottom end of the range. Yes, we could go lower, and it's got to be a -2 here at this point. But again, no reason to get overly bearish on tech. You should be overly bearish on real estate, consumer staples. They just look terrible. And speaking of another one to be short, here is materials. Another just really terrible chart here. Low bases that just keep breaking lower. Likely to go even lower here for -3 on materials. And then energy. Energy, we were bearish. It recovered. We became less bearish. And now you can see we're not bullish, but we're a 0. Look at that. A 0 at this point. When we take a look at where all the sectors were last week, the two sectors that got an upgrade were healthcare and energy. So I want you to think about that. Healthcare and energy actually improved last week during a down week. That's really telling you where the money's going right now. We got downgrades from industrials to a -3, so we now have 4 sectors at -3, staples, real estate, materials, industrials. And then we got some downgrades across the board to a -2. Now we got financials, tech, comm services, and utilities at -2s. That consumer drops down to a -1. So when we take a look at what are the strongest sectors right now, I know they're not positive, but relative strength says you should be looking for bulls in energy, healthcare, and the consumer sector, and bears in the 4 worst sectors. So let's go look and see what slots are actually available for us to trade before we place some trades this week. We had 5 trades roll off last week, and last week was a really good week. We had our trade in comm services. It was a bullish trade in Roblox. Roblox was actually up 2.5% last week, so we made max gain on that one. Again, this was a +1 trade, so a vertical spread of a 0.6 delta, so mostly a bidirectional trade. Real estate, we had NLY, Annaly Capital. That was a max gain on the bear side. Financials, we had Citigroup. That was a bullish trade. That was profitable. And then in consumer, we had a bullish trade on ACI, Albertsons, and it was 5 cents from its max gain at expiration. So close to max gain. And then our Monster Beverage Butterfly looked good until Thursday, and then Thursday it fell apart, and we took max loss on that. So 4 out of 5 for the expiring positions. Definitely not a bad week. So let's see where we stand. Let's see where we're going to put these new trades. We're at a -2 in the market. That means that these are the slots that are available to us. We now get to allocate those slots. We get to allocate where we want to put our trades. I'm going to place 6 new trades this week. And you can see I am not choosing to do a -3. I don't think it's a -3 market here. A -3 market is when the economy is also falling off the cliff, and that's just not happening. So I want to be overly bearish on the sectors that I think are going to be the worst. I've got comm services and consumer staples. I've got a mild short in financials. I'm predetermining to do a mildly bearish trade in financials. I don't know what stock I'm going to target yet, but I've already determined what the strategy is going to be and what the delta is going to be. I'm going to be doing a neutral on staples, and I'm going to be doing 2 bullish trades on healthcare and energy. So let's jump into some potential trades that we could take to look to fill these slots. And look, this is the slot strategy. People trade a lot of different strategies, but this is just a way to make trades to where everything is very regimented and disciplined. Let's take a look first at comm services. Again, I've already determined I'm going to do a -2 trade. So I want to find a stock that is breaking down and likely to go significantly lower. If you go out into the comm services sector and you pull up scans, what you'll find is you'll find a lot of the Chinese internet companies. The Chinese internet companies have really broke down. They had a nice run in October, November, and you can see this one. And understand this one is, I'm going to use the word gappy. Since this stock trades over in China, and then this is the ADR, this is also traded in America, you'll see that there's going to be a gap every single day of this position. The reason is because whatever it did over in China the night before is going to be, that's where it's going to open in the US trading. So expect lots of gaps and not a lot of movement during the US session. You're going to get movements from gaps, not from movements during the US session. So this is where spreads are just a beautiful way to play these, because then you can just quantify everything. We had this 5-day low base where we broke through this support, and you can see we fell off today. I don't see any reason why 15 would be an unreasonable target, and that is going to be the target I'm going to be using here. So if I'm looking at a -1 trade, then I want to be a little bit less bearish, but this is the one I'm looking at, the January 24th, 15-16 bear put spread. So it's going to be down to this 15. That's what I'm looking for. I'm looking for it to drop. That's about a 6 or 7% drop over the next 2 weeks. I don't want to get any more bearish than 2 weeks out. I'm keeping all of my bearishness pretty short term. You're going to see 1 week trades and 2 week trades is all I'm looking to take on the bear side. That is Billy, B-I-L-I. All right, the next sector we wanted to allocate a trade to was a bullish trade in healthcare. So I went into the healthcare sector and I scanned for trades. I'm trying to find something that is trading above moving averages, something that is giving me some bullish price action. I got to say, I didn't find stuff I loved, but remember, I'm doing a +1 trade. A +1 trade is basically a delta neutral. A +1 trade is not saying it's going to race higher. It's saying it's going to hold its ground and maybe grind a little higher. So this is OPCH. I have never traded this name before. Option Healthcare. You can see after a big nasty gap, we spent a long time basing down here. Spent a long time, and we're now looking to trade up above that. It hasn't broken out yet. Like I said, I couldn't really find anything I like better than this, but I like this sector. I like the sector for a reversal. So I'm going to go ahead and put on a trade on this. And the trade's going to be pretty wimpy. You can see the stock is at $24. So the trade is going to be a 22.50.25. So we're looking up to 25 down to 22.50. We need this to move up into the top of that range, and we only have 1 week for it to do it. So we'll see what happens. I actually do like the diagonal call spread much better, because I love this part of the month where you can go long the next month out. So you'd go long the February 21st, 22.50, and then you'd sell this week's 25. That gives you 5 days. And if the trade doesn't go anywhere or doesn't really look great, just get out of the diagonal call spread. You'll probably make 5, 10, 15 cents, whatever it is, if it just hangs in here. But if the stock actually looks like it's going to move higher and the healthcare sector starts to move, you can then let that short call expire and just hold the 22.50 call. Once we break out of this resistance here, I think this stock has a lot of potential to make it. I don't think it's going to make it back up to 30, but back up into the mid-20s, 20, 26, 27, and you've got a full month to let that long call work for you. I do like this trade on the diagonal call spread. Financials, we're looking to be a -1, so I want to find something that is bearish. Came across this one. These are what I call the March of Death. These kind of stocks where they just literally every day go down, and then they gap, and then they have rallies, and then they fall, and then they have little rallies here and there. But you can see this thing is on the March of Death. I'm looking to be very short term on this. I'm looking to be 1 week out. So I'm looking at doing the 11-10 bear put spread. The 11-10 bear put spread. And you can see here, it just has to go down a few more days this next week, and it's going to be a nice little single that we hit for this financial sector. Next up is consumer. We determined we were going to be doing a neutral trade on consumer. So we went out and scanned for neutral stocks, and it came across DraftKings. Right, DraftKings, DKNG, and you can see here, it's made a high all the way up to 45, and it's made a low all the way down to 36. So that's the real range, 36 to 45. I'm looking to be very short term on this one. So the question is, do I go for the 39 or for the 40? That's really the only question. Right now, the stock is right between them at 39.50. So I have to determine, am I going to put the midpoint slightly above or slightly below? I'm going to put it slightly above. I'm going to put it up to that 40. So just a 1 week trade, a 38, 40, 42 butterfly. So we're going 5 days. It just basically has to stay in this range. This is probably the profit area right in there. If it goes in that profit area and stays there on Friday, that's going to be a gain. If it breaks out above or below, then it's going to be a loss. Just a very easy play on a butterfly. Next sector we're looking at is the consumer staples. Now this is another very bearish sector. We want to get more bearish here in this sector. And this has been one of the worst stocks out there. One of the things I've learned in my 28 years of doing this. I had a trader ask me the other day, when I look for scans and it gives me a scan, they asked me, well, Rob, how deep do you look into the list of scans? Because, we sort them for performance, what has been the best and the worst performers. And I say, on my bullish stuff, I'll go, 30, 40, 50, 60 potential stocks deep looking for the right kind of trade. But on the bearish side, I almost never go off the last page. What I've learned in all my years is the weakest stocks are weak for a reason and they keep going lower. Just like I showed you that Rocket Mortgage, I used to avoid those saying, oh, it's already gone too much, it's fallen too far. And I would go get something that's held in and I looked, and then I checked back in on that other stock a month later and it's gone even lower. That's what happens. So this is one of the worst stocks out there. It's been bad for a long time, and you can see we just broke down. We just broke down on Thursday. I like this one on the short side. I'm going to be a -2. So I'm going to go out for 2 weeks on this one, and I'm going to do a 70-72 bear put spread. So I'm looking down to 70 for the target. Anything below 70 is going to be max gain on this. If you wanted to be more bearish on this, you could look at long puts. I do think this is a situation that long puts make some sense here. The market is in a little bit of trouble at the moment. If you want to get heavily bearish on some delta, that's the easiest way to do it. I'm going to just stick with spreads. And last is energy, the best sector at a 0. So I wanted to add a bullish one on. This was another difficult one. When I pulled out my scans and I looked in the sector, it seems like there are 10 stocks that are just ripping higher. And one of the ones I talked about on Tuesday was AR and Taro Resources. And I put that one on my trades on Tuesday saying, hey, look, this one's a really good one. And you can see it had a nice breakout to the upside. Other than those 10 or 15, everything else looks really messy in energy. And so I had a little hard time finding anything I really loved that was going to be very strong. But remember, I'm not looking for a +2, +3 trade. I'm looking for a +1. I just need something that doesn't go down. When you change your thinking to, okay, I'm not looking for something that's ripping higher. I'm looking for something that just is going to hold in. I came across this WMB, Williams Companies. Now, if you take a look back on this chart, it has a really, really big uptrend up to here. We got this correction. And then we came, and you can see we're putting in some higher highs and higher lows. This doesn't look great. I would never say, hey, I'm going to buy this because I think in 3 days it's going to be up to 59. No, that's not where it is. But you can see it's holding in. It's holding in. It's made this bottom, very convincing bottom. We got some higher highs, higher lows off this, and now it's just holding in. That's all I needed to do is hold in, but I'm going to go out a little bit longer on this one because I do expect there to be some short-term bearishness. I have time on this one. I'm going to go out to January 31st. So I'm looking at the 52.55, and that is slightly under where the market is right now, the market price. So basically, it just needs to hold that 55. If it holds above 55, this is going to be about again, 1 to 2 risk-reward ratio on this. So position size this one correctly. This one looks like it should hold in, and I'm willing to give this an extra week to really get out of any short-term bearish moves I see potentially coming down the road. All right, wrapping this up. Expect some short-term bearishness. I think we get bearishness on Monday and Tuesday. And I think that CPI report is going to be the thing that likely turns this market around. I think that CPI report is going to come out. I've seen this set up before where people are all worried and then the CPI report comes out and it cools everything off. It could happen. But look, if those numbers are bad, we will go lower from those. So I don't want anyone jumping the gun, but I'm just looking out saying, hey, you know what? I do think there's a possibility that Wednesday's price action could mark a short-term bottom, but I think we still have bearishness ahead until we get a really good technical reading that it's over. This weekend, we will be sending out our 2024 year in review. We do this every year. We go back and look through the year behind us. We look and see some of the major trends, and then we look forward to 2025 and we make some predictions and we talk about things to watch for. So we will be sending that out via email. You can watch that at your convenience. Thank you so much for joining me. Everyone have a great weekend. Goodbye, everybody.